Hi, good evening, everyone. Namaskar. We welcome you to our monthly affair, Nivesh Ki Baat, from the fund house, from our fund house, SBI Mutual Fund. Today, we have Gaurav Mehta, one of our senior fund managers, with us. He's not only going to speak about markets, but what's happening in the market. There is a lot of action. There are a couple of wars which have happened in the last couple of months. There is a lot of tariff news since we started our new financial year. And so, apart from speaking on the markets, he's also going to speak and give us a brief on the new space that has been introduced by SEBI, which is called SIF, Specialized Investment Funds, which is a category which is kind of going to bridge the gap between mutual funds and portfolio management services. So he's also going to give a brief key how does this category look like, what are the options available, and any questions thereafter. So without wasting any time, I hand over the mic to Gaurav Mehta to hear on markets first and then SIF on the category. So thank you. Over to you, Gaurav.
Thanks, Gaurav, for the introduction. Good evening, everyone. So I think Gaurav has already laid out the agenda for me, Gaurav, again, that, we divide this talk into two pieces. We first talk about markets, and then we talk about this new category of funds called specialized investment funds. So I think on markets, when you look at the Nifty, we are less than 3% away from all-time highs that we hit in September of 2024. But obviously underneath it, a lot has changed. I think a lot of uncertainty has arisen, especially on the global front. First, you had tariff wars, and then you also have had a few actual geopolitical events. But the good part is that a bit of calm seems to be returning. I think on tariff, there is a bit of negotiation that's going on. The hostility between US and China has eased off somewhat. India, US hopefully will strike a deal, or at least they look like they're working closely on a deal. On geopolitics, as we know that the key stress point for India was the fact that crude oils flared up in the recently concluded Israel-Iran conflict, but thankfully that's behind us, and the spike in crude oil is also behind us, which helps us from a macro standpoint. But when we think of markets, we usually think of markets from a asset allocation standpoint, because it's very difficult to keep track of all the news and try and second guess how markets will react every single day. The asset allocation framework helps us take a slightly longer term view and gives us some bit of a risk reward metric with respect to whether you should invest more in equities or should you invest more in debt and so on. And that asset allocation framework essentially looks at three specific aspects: valuations, earnings, and we know that valuations and earnings are two most important drivers of anything, any sort of security. And the third thing that we've also introduced in this framework is our measure of market sentiment, because we know that fundamentals should be driven by valuations and earnings. But we also know that because markets are, like all of us, emotional beings, you go through your own cycles on greed and fear, and to that extent, nothing stays at fair value. In periods of excessive market optimism, things tend to shoot up. In periods of market pessimism, things tend to shoot or undershoot. And to that extent, it's very important to get some calibration of where the market is in terms of overall greed and fear metric. Now, on these three things, valuations, earnings, and sentiment, I think what has changed favorably for India over the last 9 months, the last time that we hit a high in September 2024 till date, is that yes, while Nifty is only 3% away from the all-time highs, and in that sense, if you look at a pure metric like PE, it would look like valuations haven't eased that much. But our valuation measure looks at market equity valuations with respect to where 10-year bond yields in the system are. And on that relative spread, things have changed favorably, because 10-year bond yields, which used to be around 6.9% or thereof, or somewhere there in September of 2024, they have now eased all the way down to less than 6.3%. And this 65 basis points compression in bond yields has made equity valuations favorable on a relative basis. So I think, in spite of the fact that we are very close to all-time highs on this measure of equity valuations as a spread to bond valuations, equity valuations still do not look very expensive. If anything, they are very close to historical averages, which is a positive thing. The second thing that's also changed favorably over the last few months, thanks to the correction in the later part of 2024 and early part of 2025, is that sentiment, which was very stretched for Indian equities, and we were very euphoric on our sentiment readings in for a large part of 2024. And this is a measure that works on a contrarian standpoint. So when everyone is greedy, that's the time that you should be fearful, and vice versa. And last year was a year where on our sentiment gauges, market was extremely euphoric. Everyone was greedy, and that is why we were running very conservative equity allocations. But thanks to this correction, that metric has eased off now. And if anything, today we are very neutral in terms of market sentiment, which suggests that greed and fear now are more finely balanced, and it's not as euphoric as it was in second half of 2024, which again is a welcome change. So valuations have eased; they're back to historical averages thanks to the correction in bond yields. Sentiment has eased; it's again back to neutral levels, and both of these suggest that versus a very stretched or a very heated environment last year, equity markets today are in a better position from a long-term investing standpoint. Now, just to be very clear, there's nothing cheap. Valuations are not cheap. And similarly, sentiment is not very pessimistic. And to that extent, this is not an environment where you should just go all out and be very aggressive in your equity allocations. But because of this cool off, it's also a point where you shouldn't be too hesitant with respect to your equity allocation. So I think this is a good environment to continue with your systematic approach to equity allocation. The third piece of this framework is earnings. On earnings, yes, we have been in a slow lane over the last few quarters. And part of that is because the economy itself was slow, and part of that is because the sort of margin benefits that we were seeing last year that waned away. But I think the good news now is that RBI is acting decisively, and what we call triple easing is what RBI is currently embarked upon. The first is they're cutting rates. The second is that they are injecting liquidity, and third is that they're also easing on regulation. And this combination of this triple easing, we think, should support domestic loan growth. Obviously, monetary policy cycle works with a lag, so at some point this should help loan growth in the country, which in turn should put a lid to domestic economic growth. So I think domestic economy should start to look up sometime over the next few months. And the challenge, however, is more on the global front, where trade uncertainties still loom large. We are talking about trade deals, but that hasn't happened yet. On its part, India has been constantly increasing its market share. We also signed an FTA with the UK a few months back, and while that will get operationalized only over the next 12 months, from a longer term point of view, that's a positive. We're also talking about a deal with EU. Maybe that will happen somewhere in calendar year 2026. And if we are able to also sort of reach some sort of agreement with US, I think from a market share standpoint, India stands in a good situation where it should increase its exports market share. But if global exports themselves stay weak, I think that will be a headwind for our export growth as well. So I think the global environment at best remains wobbly at this point in time, but the good news is more on the domestic side, where RBI's actions should lead to the economy at least starting to improve from here on. And that in turn would mean that we may have already seen the worst on earnings growth as well. So neutral valuations, neutral sentiment, and hopefully tough earnings, which should start to improve from here on. Maybe not by a whole lot, but at least directionally it should be better versus the last few quarters. I think that combination means that this is a decent environment for markets. Again, nothing is cheap, so to that extent, this is not an environment where you go all in. But this is at least an environment where you continue with your long-term systematic allocation to equities. Within equities, our preference at this point is for quality stocks because, as I said, the macro environment is still recovering from a low. The global environment is still wobbly, and to that extent, one should not invest in speculative narrative-driven stocks. And quality, which was a dominant style in India for a good part of that decade from 2010 to 20, and which over the last 4 or 5 years has been sidelined to some extent because of the cyclical recovery. We think this is a good time for quality to start staging a comeback. So I think within the equity exposure, we think quality should be looked back at, and that should be the dominant allocation to portfolios at this point in time. So I think that was a brief overview on how we are looking at markets at this point in time with respect to our allocation framework. But I think as Gaurav Dharmara earlier pointed out, we'll now also shift focus to a new category of funds that SEBI has recently sort of drawn regulations upon, and that very soon should hit the markets in India, which is the specialized investment funds. Now, conceptually, SIFs are a bridge between conventional mutual funds.
There is a request. Slow down.
Okay. Now, when you think of SIFs, they are a bridge between conventional mutual funds and PMS and AIF and those category of investments. Now, when you think of mutual funds, there is practically no minimum limit, right? Anyone and everyone can participate. When you think of PMS and AIF type products, there is a minimum threshold. On PMS, you have to have minimum 50 lakhs to invest in a single scheme. On AIFs, that minimum threshold goes up to 1 crore. What the SEBI, I think, has said is that there is a demand in between where people want to have differentiated risk reward products. But at the same time, they also think that there is a large category of investors who are not playing at that 50 lakh 1 crore bracket. And which is why from an investment limit point of view, on SIFs, the limit has been brought down to 10 lakhs per AMC. So very simply put, what that means is that if SBI AMC launches 2 or 3 SIFs to begin with, then across those 2 or 3 strategies, you have to maintain a minimum of 10 lakhs with SBI within that AIF within that SIF category. So I think which is a very welcome change versus the large thresholds that you had for PMS and AIF. From an investment point of view, the second thing that SIFs allow investors to do, or to fund managers to do, is to also short. Now that short percentage has been restricted to 25% for unhedged exposure today. And I think this is again a very big difference between mutual funds, because conventionally mutual funds cannot go naked short. What that very simply put means is that if I think that a security is overpriced, there is no way for me to benefit from that view. If I think that this price should go down, I can't benefit from it in a conventional mutual fund, because mutual funds are largely long only products. I can obviously short there to hedge my existing exposure, but I can't go naked short on something that I think is expensive and should come down, or something that I don't think deserves to be at the current price points and it should go lower. There is no way I can participate in that view. With this 25% unhedged shorts that SIFs are allowed to do, you can have, of the 100 rupees of AUM, you can have up to 25 rupees earmarked for such shorting opportunities. And I think that is a very, very interesting proposition. Obviously, AIFs could do that, but as I said, AIFs were at a very high ticket size. Now it allows a large population of investors to participate in some of these products where you can also go short. And what this should allow asset managers to do is to create risk reward propositions which are very different from conventional mutual funds. And we'll talk about that in a while. But the third thing, which is also different from mutual funds, and I think for a lot of our participants here who are distributors, it's something that they should bear in mind and start preparing for it today, is that all conventional distributors who have been selling mutual funds are also allowed to sell SIFs, but they have to have one certification, which is NISM Series 13 derivatives module. So they have to clear that NISM Series 13 derivatives exam in order for them to be able to distribute SIFs. So I think that's the only small sort of challenge versus conventionally selling mutual funds. But I'm sure you have sufficient time to prepare for it, and hopefully this should not be a roadblock in your ability to sell SIFs. Now I'll briefly talk about what are the various categories of SIFs that SEBI has allowed, and essentially they've talked about 7 categories so far. 3 of these are equity categories, 2 of these are debt categories, and then there are 2 asset allocation or hybrid categories. Within equities, again, there is one category where you can do long short without any market cap constraints. So you can be in large caps, you can be mid caps, you can play wherever you want. There is a second category where you have to have at least 65% of your assets in non-top 100 stocks. So that would mean in the second category, you have to largely play in non-large cap space, which is mid and small caps. This is obviously going to be a category where the risk reward proposition is more skewed towards high risk, high reward. But it's an interesting category nonetheless. I think I forgot to highlight this earlier, but one key advantage that SIFs enjoy versus conventional PMS and AIF products is that there is a lot of tax clarity, because SIFs being a part of mutual fund will have the same taxation as mutual funds, and to that extent, it's a very tax efficient product versus AIFs and PMSs. So this is the second category where you have to play non-top 100, and there is a third category of equity SIS where you can do sector long short, and you are allowed to only have 4 sector exposures. So for example, theoretically you can be long on 3 sectors and short on 1 sector. Across these 3 categories, as for all SIF categories, you can have up to 25% of shorts, of unhedged shorts at the maximum. Beyond these 3 equity categories, there are 2 debt categories. One is an unconstrained category, and the second is a sector long short. And then there are 2 asset allocation or hybrid categories. First is an active asset allocation long short, where you can practically invest anywhere between equity, debt, commodity derivatives, REITs, InvITs, both on the long side as well as wherever possible on the short side. There is a second category of hybrid SIs where you have to necessarily play largely between equity and debt. So both your long exposure as well as your short exposure should largely come from equity and debt in this category of SIs. Now, somehow there is this perception that derivatives means ability to speculate and make a quick buck. I think that's where we want to differ a bit, which is that derivatives are not just a leverage instrument to generate fast return, but more importantly, and the role of derivatives also is very critical with respect to your ability to hedge. And which is why I think when you think of SIS, I don't think that you can paint it in one brush and say that this is going to be necessarily high risk or low risk versus mutual funds. And I think with these 7 categories, SEBI has provided enough flexibility to asset managers to play across the risk reward spectrum. So for example, very initial thoughts at this point in time, but let's say the hybrid long short category where you necessarily have to play between equity and debt, and there you have to have minimum 25% exposure in equity and minimum 25% exposure in debt. I think that is a category where you can create a risk reward proposition which is more skewed towards low risk, but close to double digit kind of returns. And I think given the tax environment today, a product which can on a tax efficient basis give you closer to 10% returns with very low risk, I think is going to be I think that's been a very big missing link so far, and I think that's a demand which can be bridged to this category of funds, right? Limited risk and ability to generate close to 10% returns on a tax efficient basis. And which I think will be scalable, which I think is something which is need of the hour. Similarly, when you look at the first category that I spoke about, which is equity long short, where you don't necessarily have to go to small caps, there you can theoretically create through a clever use of futures and options. You can potentially create a risk reward proposition which is more like Nifty Plus, where you try and generate slightly better returns than Nifty with a better risk outcome versus the Nifty. And that is something that can compete with the conventional passive products, the Nifty ETFs, so to speak, with a better risk reward versus a Nifty ETF. Again, these are early days. And then, somewhere on the other extreme, you can have high risk products. For example, the non-large cap equity categories where you can have very concentrated mid and small cap exposure on the long and the short side, which can be a high risk proposition. Similarly, the sector allocation long short, I think, is again something where you can create a high risk proposition where you are trying to navigate the business cycle by identifying long sectors and short sectors. So I think that entire spectrum of risk reward is possible given the categorizations given by SEBI so far. And I'm sure different AMCs will try and play that game. I think from our point of view, we are excited about this space, and very soon you should hear something concrete from our side. But I think broadly speaking, that those are our initial thoughts on what the SIF category is all about and how it can create a very differentiated risk reward perspective proposition versus conventional mutual funds, as also more tax efficiency and lower ticket sizes versus AIFs and PMSs.
Thank you very much for a very very patient hearing. हमने जब ये सेशन प्लान किया था हमें पता था कि सेशन टॉक करीब 20-25 मिनट का होगा और क्वेश्चंस करीब 1 से 1.5 घंटा चलेंगे और एग्जैक्टली वैसे ही हुआ. So that talks about your interest in this category, and let me reiterate that being the largest fund house, and thank you very much once again all of you. Today we crossed the landmark of 12 lakh crores. So thanks to support from all of you, and with your continued support in future, we will continue to bring in more exciting, committed products for making wealth for your customers. Thanks for a long session and your commitment towards SBI Mutual Funds, and we close this call now. Have a good evening. Bye-bye.
Thank you.
Dhanyavad. Namaskar.
Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.